Joining us here at Post 9 this morning, former St. Louis Fed President Jim Bullard, now Dean of Purdue University's Business School. Jim, it's great to have you in. Welcome.
Great to be here.
There was a point earlier in the year where you said it might be smart to cut sooner but slower. You feel the same?
Yeah, I do, but it's kind of a subtle point, so I don't know if that's... I would like the technical adjustment idea, kind of a little bit more Greenspanian. You would take on board the fact that inflation came down a lot in the second half of 2023, and you'd make some adjustment without promising too much out there in the future. But there wasn't really a moment for the committee to do that, and so they've stuck with the higher for longer.
Do you think they'll continue to?
Yeah, I mean, they're going to have to see further progress on inflation in order to make a move, and it's not that clear that we're going to get it, but maybe we will if it resumes, disinflation resumes in the second half of 2024 here, and so we'll look to the next inflation reports, including one tomorrow.
Right. Yep. Steve mentioned other central banks. Does that put pressure on them to follow suit in any way?
I don't think so. I think the ECB got burned a little bit here with their move. They committed pretty early that and the compromise on their committee was that they would go in June. Then in the run-up to the meeting, you've got data going the wrong way, and they probably would have been better off, postponing a little bit if they had their druthers. But so now they're going to have to manage that going forward. So I think the FOMC would do well to not get in that position where you're moving on a day when the data is going in the wrong direction.
But I mean, the data is so it's kind of up and down, and it's not like the disinflation is completely reversed, even in the United States, but also in Europe. So I'm not sure they got burned.
No,
she's managing to...
Okay, so you're moving in a more dovish direction on a day when you're upgrading your inflation forecast, your inflation outlook. I think that's the juxtaposition that you don't want. And my experience on the FOMC was that the committee gets in trouble on those kinds of moments because what are markets supposed to think? You can explain, you can do things, but what are markets supposed to think if you're moving in one direction and your forecasts are moving in the other direction?
But that's just like saying, what are markets supposed to think with this whole data dependence thing? Yeah. As a whole, which is where the Fed has been, which is where the ECB has been. It's not clear.
Yeah, I think you have to react to the economy, so you have to be data dependent. But do you really want to be data dependent out to the third decimal place on something? Probably not. And obviously, we can't measure things that accurately anyway. So it's a mistake to try to overreact. So it's an art form to get the right level of focus on the data.
It does kind of raise the question about survey response rates having collapsed over recent years, the weird nature of soft versus hard data, high-frequency data. How did you think about that back when you were on the committee?
The committee loves hard data, and I think it's certainly informative. It's very informative to talk to businesses, and I did do a lot of that, and most of the committee does a lot of that. Just talking to people about their businesses, but it takes some interpretation because it could be just something that's going on with their business, could be something that's going on in the industry. You guys have this too. And then, but if you hear the same story over and over again, then, okay, well, there's something going on. So I think there's an art form around that.